If you want to be an algo trader, you have to start thinking like an algo trader. What does that mean? How do you do it? I'm champion trader Kevin Davey, and in this video, we're going to find out. So if you want to think like a trader, how do you do that? And really, what does that even mean? Let's find out. Well, first, I have to tell you my trading history. The first 10 years or so of my trading, I did everything the wrong way. Anything you could possibly imagine. I probably did it, and I probably did it incorrectly. But then I started to look more into what I was doing and what I was doing wrong. And I realized a lot of times I didn't think like a trader. And I didn't act the way a trader should. And that's what I'm going to talk to you today about. Because that was when I had my breakthrough of when I really started to get better at trading, was when I started to think like a trader. So like I said, what does that actually mean? Well, there's a couple ways that you can think like a trader. First, you have to really understand the trading metrics, the performance metrics that are involved. Second, you have to realize equity curves are not always what they seem, and so it's kind of a big fallacy with equity curves. And we'll talk about that. And then finally, you have to learn how to think with a probability mindset. And you might be saying, whoa, what's that mean? I'll talk about it in a little bit, but if you do these three things, you'll start thinking like a trader, and not guaranteed, but because nothing's guaranteed, that would be a probability, right? It's not guaranteed, but chances are your trading should get better. So let me start out with some questions for you. What would you rather have? A strategy that wins 90% of the time, a strategy that wins 10% of the time, or you don't know which is better? Okay, I'll give you a second to think about that. Then the next question, do you want a strategy where the reward to risk ratio is 3-to-1? Or would you rather trade a strategy where the reward to risk ratio is 1-to-3? Or can you say you don't know? Okay, which one would you pick here? And then one final question. Just look at this equity curve. Would you trade it? Yes, no, or I don't know. Okay, so now look at your answers for all three of them. And if you answered C to all three of them, congratulations. You're already thinking like a trader, because those questions were kind of open-ended and there was no yes or no, good or bad answer. You just didn't have enough information. And a good trader will realize that. So the first part about thinking like a trader is knowing which performance numbers to focus on and which to avoid. I just showed you winning percentage and reward to risk. Are those good or bad? You have to dig deeper a lot of times into these trading statistics. And if you use the performance numbers correctly, they're going to increase your trading confidence. So all this is really important to do correctly. So for example, most people focus on items in those first two questions, either winning percentage or reward to risk ratio. But the fact is, either one by itself is useless. It's useless and meaningless. Let me show you why. Okay, so example 1, 90% wins. Every time you win $1. 10% losses, you lose $10. So you're getting a lot of little gains and then you hit a big loss. Okay, that's example 1. Example 2, 90% of the time you're getting $1 profit. So you're You can think of this as little scalping. And actually, I said that. Okay. So let's look at what's really important. Let's look at winning percentage. So example 1, you have 90% wins of $1. So you get these real little itty bitty wins, and then 10% of the time you get hit with this big loser of $10. Okay, that's example 1. Example 2 is 90% losses. So you got a lot of little losses, and then every once in a while you get a big win. 10% of the time you get a $10 win. So if you think winning percentage is all that matters, of course you'd pick example 1, right? You'd say that's the better system. It wins 90% of the time. Well, when you look at the math, you actually lose with example 1, but you win with example 2. So my point, winning percentage does not tell the whole story. You can look at the same thing with reward to risk. A lot of people, you'll hear a lot of people say, oh, you need 3 times the reward to risk. Well, let's say you do that 20% of the time, or you have the reverse where you get $1 reward for every $3 risk, but you win 80% of the time. Which of those is better? Well, again, it's not what you'd think. Just because the reward to risk is better doesn't mean it's a better strategy. So again, this number by itself does not tell the whole story. And what's bad is a lot of people never go beyond this. They just look at either winning percentage or reward to risk and just go with it. You got to dig deeper. And the way you can dig deeper is by looking at what's called expectancy. And this includes the reward, the risk, the winning percentage. It kind of encompasses it all. And simply put, it's just your average profit per trade when you add up all your winners and all your losers. And you can go a step further, and there's something called the Tharp expectancy. It's Dr. Van Tharp, who was a market wizard. And then you divide it by your average loss, and you can get a good idea if it's a good system or not by looking at the expectancy. But the point is, it includes both risk, reward, and winning percentage all in one number. So the point is, you got to dig deeper. Every performance number can give you some useful information, but a lot of times it won't give you the whole story. So you want to try to combine numbers and look at things that give you more of the story. And certainly expectancy is one way to get more of the story. Okay, so at this point, if you like this video, please do me a small favor. Give it a thumbs up. Give it a like. I would appreciate it. Subscribe to this channel. Join my email list. You get a free algo. When you do that, that'd be great. All right, back to the show. The next thing is historical performance, equity curves. Everybody loves to see equity curves, and they decide whether or not to trade a system based on it, how to position size, when to stop trading. But the problem is the equity curve only tells you so much. And by itself, they're not all that great because they just tell you what happened, not what could have happened. Maybe the trades are in slightly different order. You could have had a much bigger drawdown. And they can also be easily manipulated, both by people selling trading systems. The good ones know how to create perfect equity curves and great looking equity curves that are just junk. And the ones you create can be garbage too if you over optimize and curve fit. So just looking at an equity curve doesn't tell you everything. You know, it just shows you one thing, but it doesn't tell you how the system was created. And a lot of people kind of have a problem with that when I say, hey, by themselves they're junk, but the fact is they are. And it's only in context with how you develop the system and what kind of slippage of commission you used and what kind of optimization you did, and is this in sample or out of sample. That's the true test of an equity curve being good or bad. So, like I said, it's very easy to create an equity curve, but you have to know how it was created. And what do I mean by that? Well, there's 4 different ways really to create an equity curve. You can do a traditional back test where you optimize everything and trade it live. You can do an out of sample test. You can go a step further and use a walk forward test, which is out of sample, or you could just go to live trading. And you see, depending on which way you test here, there's a red area, which is in sample. That's just garbage. You don't want to use that data to evaluate a trading system. And then there's the green, which is out of sample, which is good. And then there's the blue, which is live, which of course is good because it's real. So what you want to do is you want to maximize the blue and green, the combination of the blue and green. And when you do that, you see the traditional back test is the worst. And you can't do worse than that. There's very little blue. And the fact that you optimized it will probably mean it won't be working going forward. And then the walk forward has the most green and blue when you add it all up. And that's why I use walk forward testing. The other thing with equity curves is you got to know how many rules and variables were used to build it. It's pretty easy to curve fit a system when you have 50 or 100 variables that you're optimizing. In fact, it's really simple. The scary part is even with 4 or 5 variables that you're optimizing, you can still do a good bit of curve fitting. So you want as few variables, as few rules as possible, and that will make your equity curve more realistic. And don't forget, by realistic, I don't mean it's going to be a good-looking equity curve. I mean it's going to be one that is likely to perform about the same in real time. That's what you're looking for. You're looking for something in a backtest that will continue on into the future. So my rule with equity curves, unless you created it, unless you know you created it the right way, just doubt them. Just dismiss them and say, hey, I don't believe this equity curve. And trust me, you do that and you'll be much better off with internet ads and all this other stuff that's out there. You'll believe what is real, not what is fantasy. Okay. The other part of equity curves is position sizing. A good equity curve won't have big losses probably, yet maybe the way you're trading could have had a big loss had things worked out a little differently. So if you position size assuming there's never going to be a big loss, yet there really could be, you're probably going to get wiped out at some point. So just because an equity curve doesn't show risk doesn't mean the risk wasn't there. It just means you didn't experience it for that particular strategy. The way to think about it is with drawdowns, the worst drawdown is always in the future. And if you have that mindset, you're going to be much better off. So the point here, again, is just to dig deeper. A good trader knows to look beyond the equity curve and knows to dig into the information in the equity curve. How was the strategy built? How was it optimized? What kind of process did you use? What kind of risk maybe that never happened could I expect in the future? That's the way to look at an equity curve. Okay, so we've covered equity curves and performance numbers. Let's talk about probabilities. So let's have a little role playing here. Let's say you're going to open a casino. You know, you've become wealthy somehow, and you're going to open a casino. How much cash should you have in your cashier's cage to handle losing bets? That's the question for you. You might say, that's a weird one. Well, as a casino owner, you have to remember the long-term probabilities are in your favor, which is good. But the bad side is maybe you get some big whale, a big gambler, so they call them whales, who bets big and wins big, and you don't have enough cash to cover him, to pay him off. How long are you going to stay in business once that gets out, that you couldn't afford to pay off your debts from gambling? You're not going to last long. So if you don't have enough money in your cashier's cage, you could go bankrupt in the short run, even though you know the long-term probabilities are in your favor. So think about that for a second. You know in the long term you'll make money, but in the short term, anything can happen. And if you start to believe that, apply it to trading, and you'll realize anything can happen in trading, and it will change the way you think about any individual trade or any individual week. What I mean by that is the situation is even worse in trading, because you think you know the probabilities because you ran a back test, but the back test is always going to be somewhat optimistic, and maybe the market could change. Maybe you did curve fit. Who knows? But if you know all this up front, you can take care of the probabilities and make sure that even if things go wrong, you're still not going to get completely wiped out. That's how you think in terms of probabilities. You realize nothing is 100%. You don't think just because you have a great trading system with the great performance numbers and the great equity curve, you don't think it's 100% certain you can make money. Because like I said, the backtest results could almost always be worse. And usually they will be, because the backtest usually has some good luck built into it. Problem is you don't know how much. So when you understand that and think like a trader, you're going to start to trade defensively. You know, and you'll never do what reckless gamblers do when they just let it all ride and that kind of thing. That's crazy. So the way you size your account, the way you will control your risk, is you'll realize that, hey, I could really mess up and my risk of ruin could be pretty big. So you'll account for that. And I want to show you risk of ruin and how it can change things. So let's just do a coin flip game. If I flip heads, you win $1.50. If I flip tails, you lose $1. Okay? So we were talking about expectancy. So that includes winning percentage and reward to risk. Your long-term expectancy is 0.25, which means on average you're going to make 25 cents per flip. So if you did 500 flips of this coin, you should be up around $125. You'd say, wow, man, that's great. The problem is if you start with not enough money. And what I mean by that is, let's just say you started with $2 in your pocket and you're going to play this coin flip game. Now, what I've done is I've put this data into my Monte Carlo simulator. This is a spreadsheet you can get from my website for free, and you can run trading systems with it. I'm running the coin flip game with it, but I start out with $2. If I ever hit 0, hey, I can't bet anymore, so I'm wiped out. I'm going to do 500 flips. You can see historically half my flips were winners and half were losers. And I look at risk of ruin and the probability of winning years. So depending on my equity, the chart on the left shows, hey, if I only start with $2 of equity to start, there's a 40% chance I'm going to get wiped out. That I'm going to go to zero and I can't play anymore. Ugh, well, I don't want that. I wanted to be in for the long term to win, right? Because I know this game's in my favor. So if I start with $6 or $7, then my risk of ruin goes down to around 10%. That's certainly a lot better. But, if I had $100, my risk of ruin would probably be close to zero. So the point is, the more money you start with, the better off you are. And if you start with too little, you're going to get wiped out. And by the same token, if you want to have winning probability after 500 flips, it's the same way. The more equity you have, the longer you can stay in the game to counteract those, bad luck, just, 4 tails in a row, and you're like, how did this happen? It happens. And you have to account for it. So you can imagine if your risk of ruin with a coin flip game is so high when you know the probabilities, imagine with a trading system where you're really unsure of the probabilities, what could happen. You need enough money in your account to prevent you from being wiped out. And this is the reason why most small traders with little accounts get wiped out. They just don't respect this risk of ruin and how this thing works. And if they'd have twice the amount of money or 10 times the amount of money in their account, they might not get wiped out. This shows you that you can get wiped out even with a winning system, because I'm sure you'll agree this coin flip game was a winning system. Yet, if you don't start with enough equity, you can get wiped out. So again, you got to dig deeper. You can't just look at things at the surface. A good trader knows to look at probabilities and make decisions based on them. And the really tricky part about all this is you could have good long-term probabilities, but in the short run, things could certainly go bad. And so you've got to account for that. So think long-term, but also be prepared for that short-term. Don't be that casino owner who doesn't have enough money to start with, who gets wiped out before the long-term winnings come. That's the way to think about it. Okay, so to think like a trader, don't focus on any one performance number. Look at combinations of them. Dig deeper into the statistics that are behind them. Watch out for the equity curves. They can bite you. They're not all they seem. They can be useful, but don't take them for granted. There might be some hidden risk involved in those. And then start thinking in terms of probability. Think about this coin flip and how you could still lose money playing a winning game. And when you start to think like this in all these areas, you'll start to think like a trader. You'll start to trade better. All right, so that kind of wraps it up. Again, if you like this video, please, small favor, just give me a thumbs up. That'll make me continue to make these videos. If nobody liked these, I wouldn't do them, right? So I rely on your feedback. Subscribe to this channel. Leave a comment if you have a comment. I'd love to hear it. And if you want a free algo, go to my email list. So thanks for watching. I'm Kevin Davey. Have a great day.